Over the next several minutes, we'll cover information you will need and want to know. These are the topics we'll review together. What are the true benefits of Social Security? Will Social Security be there for you? How is Social Security calculated? When should you file for your Social Security benefits? We'll discuss in depth the topic of spousal benefits. We'll take a close look at survivor benefits. We'll go over the 2 case studies that will show you how to maximize your spousal benefits. And lastly, we'll discuss how you can best coordinate Social Security with your full retirement plan. Again, thank you for spending a few minutes of your time with us today. We hope the information is helpful.
What are the true benefits of Social Security? Social Security is one of the more important pieces to your retirement plan for 3 basic reasons. The first reason being that you cannot outlive your Social Security. Did you know that the number one concern that retirees have today about their retirement is the fear of running out of money? With Social Security, it is one of those income streams that you cannot outlive. Secondly, Social Security has a COLA associated to it. In other words, every year when there's inflation, Social Security goes up with that rate. The COLA is associated to a CPI index, which grows as the cost of goods go up every year. The average COLA since inception has been approximately 2.8%. This inflation protection with Social Security is a very unique and important part of your Social Security payments. For example, most pensions and other investment accounts do not automatically keep up with inflation. So this is a very key part of your Social Security income. Thirdly, Social Security has some unique benefits available to it for people who have been married, or are currently married, or who are planning on getting married. Those are called spousal and survivor benefits. We will spend some time during this presentation explaining the different roles of the survivor and spousal benefits. These are the benefits of Social Security, and we will go into more detail of each of them throughout the rest of this presentation. One of the largest concerns with Social Security that leads people to file for Social Security too early would be the concern of whether or not Social Security will even be there for you into the future. And if you're watching the news or paying attention in the media, you hear of all sorts of different reforms that they're looking to do to change your Social Security benefits. Some of the things they're looking to do to reform Social Security going forward will not affect the current baby boomer generation, especially the later part of that generation. Some of the things they're looking to do to change Social Security will be for those younger generations of people going forward. Currently, Social Security full retirement age is between the age of 66 and 67, depending on what year you were born. They're looking to raise that full retirement age incrementally going forward into the future. Another option for reform is changing the way the COLAs are calculated for the growth in your Social Security year by year. Currently, the Social Security COLA is based off of a CPI-W index. They're looking to simply change that to a CPI chained index. Those changes will likely not affect many baby boomers today. All in all, we feel very confident that if you are a baby boomer, especially those on the later end of the baby boomer generation, your Social Security benefits will likely not be affected by any Social Security reform. So let's take a look at how your personal Social Security benefits are calculated. Social Security benefits are calculated off of 2 variables. The first variable is how much money did you pay into the Social Security system? In other words, how much did you put in over your top 35 years of working? In order to have any type of a Social Security benefit, you must have at least worked 10 years or 40 quarters. What happens is you take your top 35 years, they jumble it into an equation, and out comes a very important number that you must know. It's called your PIA, your primary insurance amount. This number is basically your full Social Security benefit at your full retirement age, whether that happens to be 66 or 67. Once we determine what your PIA is, we can then determine what your benefits will be based on what age you are when you file for your Social Security benefits. You can file as early as 62 for early benefits at full retirement age, which could be 66 to 67, and then you can wait as long as 70 years old. Depending on what age you are to file for your benefits determines what your benefit will be for the rest of your life. So this is a decision that you should not make quickly. If you file for your benefits prematurely or before full retirement age, you will receive a reduction on your benefits and also some stipulations on how much money you can earn if you continue to work. So for example, if you have a PIA or a primary insurance amount of $2,000, but you file for your Social Security at the age of 62, you will actually receive a smaller benefit for the rest of your life. That benefit would be 75% of your PIA, which in this case would be $1,500. If you decide to wait till your full retirement age, you will receive 100% of your PIA or of that $2,000. And of course, if you decide to file for your Social Security benefits anywhere between the ages of 62 and 66, you will receive a larger percentage up to 100%. It goes from 75% up to 100% prorated per month that you wait. Once you're at the age of 66 or full retirement age in this situation, you can continue to work, make all the money you'd like at your job with no withholdings from your Social Security. Some people decide to delay their Social Security benefits either because they're continuing to work or they're using it as a larger strategy. Every year that you wait after your full retirement age, you're entitled to an 8% delayed credit. So if you decide to wait till age 70, you will actually receive 132% of your full PIA. This benefit will continue with you and or your spouse if you pass away for the rest of your life. So in summary, deciding on what benefits you're entitled to will be based off of how much you have put into the Social Security system, in other words, your top 35 years of income, and then at which year you decide to file for your benefits. That is how you can determine what your Social Security will be going forward. This decision should not be taken lightly because the benefits that you receive on Social Security will be the benefits that you receive for the rest of your life. Now, if there's one part of this presentation that you need to pay close attention to, it's this part about spousal benefits. This is where you can make the most money from your Social Security benefits. This is one of the more misunderstood parts of Social Security, so let me break it down for you. If you are married, you are entitled to a spousal benefit. Let me explain how the spousal benefits work through an example. Let's use a husband that has a $2,000 PIA. And as you remember, PIA stands for your primary insurance amount, which is the full benefit that you can receive at your full retirement age. So if this husband has a $2,000 PIA and his spouse has an $800 PIA, here are their options. When she goes into the Social Security office, she can choose between one of two benefits. She can take all of her benefit or half of his. In other words, she can have all of $800 or half of $2,000. Obviously, $1,000 is more than $800, therefore she will take her spousal benefit. Even if that spouse had never worked outside of the home and never actually received her own personal PIA, she is still entitled to that $1,000 a month. So with this family, the primary breadwinner has a $2,000 benefit, and if his spouse is getting half of that, $1,000, they're getting $3,000 as a family. Now, divorced spousal benefits are also available to you if you have been divorced to someone that you were married to for at least 10 years and you're currently unmarried. Another important thing to know about spousal benefits is that you can actually file for spousal benefits before your full retirement age. The earliest a spouse can file for benefits is the age of 62. If you file for benefits early, you will receive a smaller percentage. So instead of receiving 50% of the PIA of the working spouse benefits, you would only receive 35%. That percentage does grow month by month up to the full 50% at your full retirement benefit. Another catch about spousal benefits is the fact that the primary worker must have at least filed for benefits before the spouse can take those spousal benefits. This is a very important part of calculating what your Social Security benefits will be for that spouse going forward. So now that you have a better understanding of how spousal benefits work, which is while both spouses are still alive, let's now talk about survivor benefits, which is when one spouse passes away. Let me simplify this through an easy example. Let's take a husband who has a PIA and actual benefit of $2,000 a month. And let's say his spouse has an actual benefit of $1,200 a month. As a family, they're obviously getting $3,200 per month. When one of the spouses passes away, the smaller benefit is lost and the larger benefit is inherited by the surviving spouse. Therefore, it is always important to try and do your best to maximize the primary breadwinner's benefit, because that's the benefit that will continue with the surviving spouse. So in summary, if you are the primary breadwinning spouse and you have decided to delay your benefits, let's say till age 70, and you happen to pass away, that is the benefit that your surviving spouse would receive for the rest of his or her life. Therefore, it is strongly recommended that the primary breadwinner always delays their benefits as long as possible, because that's going to be the benefit for the surviving spouse for the rest of their life. As we've learned earlier, you cannot file for a spousal benefit until the primary worker has filed for benefits. This oftentimes becomes problematic when planning for your benefits. So let me share with you a real-life example of how you can maximize your spousal benefits through a strategy called filing and suspending. Let's take a couple. Both of them are 67 years old. Let's say that her benefit is $250 a month. His benefit is $2,500 a month. Let's say that she filed for her benefits at the age of 66, so she is receiving $250 a month. He does not want to file for his benefits because he is going to continue to earn his 8% delayed credit. But because he has not filed for his benefits, she is not entitled to the spousal benefit. So let me share with you what this individual could do. He could walk into the Social Security office, file, and suspend his benefits. By suspending his benefits, he is not actually receiving income on a monthly basis, which entitles him to the 8% delayed credit. But because he has now filed, his wife is now entitled to $1,250 a month, which is a $1,000 raise. She's also entitled to go back 6 months to back pay that payment. So she will receive a $6,000 payment plus $1,250 a month going forward for the rest of her life. Then when he turns 70, he's available to then go in and file for 132% of his full benefit, which is a nice thing to do for 2 reasons. Not only will he get a larger benefit for the rest of his life, but if he then passes away, she inherits the larger benefit. That strategy is called filing and suspending. Now let me share with you another real-world example of how you can maximize your spousal benefits through a little-known strategy called restricting your benefits to then file for a spousal benefit. Or some will call it claim now, claim more later. Here's the example. Let's have a husband and wife again, where the husband has a $2,000 benefit, the wife has an $800 benefit. When they're both 66, she files for her full benefit, which would be $800 a month. He decides to delay his benefits in order to earn the 8% delayed credit. But while he's waiting from the ages of 66 to 70, he's actually entitled to take half of her benefit as a spousal benefit. So he's able to take $400 a month for 4 years while his benefit continues to grow. So as a family, from the age of 66 to 70, she's receiving her $800, he receives his $400, and they still earn the delayed credit on his benefit, so his $2,000 will grow by 8% per year, which also benefits his wife later on if she happens to outlive him. Therefore, another win-win scenario that very few people are taking advantage of. So in summary, it's always important to look at your different options that are available for your spousal benefits. We've discussed the file and suspend strategy and also the restricting and filing strategy. Either of these strategies could be a powerful tool in maximizing your lifetime Social Security benefits. So we have discussed some powerful information and strategies on how you can personally maximize your Social Security benefits. These decisions should not be taken lightly. Filing for your Social Security and maximizing it effectively must be looked at as part of a holistic strategy. You must look at how your Social Security affects your other sources of income going into retirement, such as your pension income, income from your IRAs and 401ks, the required minimum distribution that comes from your IRAs and 401ks, your non-qualified investment portfolio, and whether or not you're planning on working. Most people don't realize that Social Security can be taxable as ordinary income. Up to 85% of your Social Security can be taxed. This tax is determined based off of your provisional income. The equation for your provisional income is your adjusted gross income plus all tax-exempt interest plus 50% of your Social Security benefits. Therefore, when and how you file for your Social Security benefits impacts all of your other streams of incomes. For example, what do you file for first? Do you file for your pensions, 401ks, or Social Security first? Or do you delay them out and take them in different orders? This is called sequencing your retirement income. It is important to coordinate the different type of assets as you approach retirement on how to distribute those and when you will distribute those. It is advised to use a professional when determining how to do this. It will greatly impact the amount of taxes you pay on your Social Security. You might consider at building a tax-diversified plan going forward so that you can reduce your Social Security taxes at least year by year. Once again, a professional is needed in order to accomplish this properly. In summary, throughout this presentation, we have shared with you some valuable information that can help you and your family have larger lifetime income benefits from Social Security. These income benefits could potentially be hundreds of thousands of dollars larger than by not following these strategies. We hope that this presentation has given you a new insight on how to maximize your Social Security and how important it is to file for your benefits correctly. We truly want to thank you for taking the time to watch this presentation.